Hello, guys. This is our first webinar series of Introduction into Global Financial Markets. It's one of our first educational webinars that we're going to talk about the interconnectedness, a network of markets and exchanges that facilitate the trading of financial assets such as stocks, bonds, currencies, and commodities and derivatives around the world. Okay, let's start with the fact that there are different types of financial markets. Each have their own characteristics and functions, such as the stock markets and the bond markets, the foreign exchange markets, which we'll be focusing on today, specifically the Forex markets and commodity markets and the derivatives markets, which you may already be known or know as to like options, futures, swaps are traded, and derivatives that allow investors to hedge their risks and speculate on market price movements. So we offer these courses to everyone because we believe in the common interests of both the client and the company's success. And theoretically, this will give you sufficient education to start the right trading journey by bringing traders a step closer to rely on themselves and make profits in the long run. So the first thing that I'd like to start with is currency trading, also known as the Forex market, and it's the largest financial market in the world. It is decentralized and where currencies are bought and sold with participants, including banks, corporations, central banks, individual traders known as retail traders, and investors and institutional investors as well. So market opening hours, basically the Forex market operates 24 hours a day, 5 days a week, excluding like the weekend. So let's say we don't trade on Saturdays and Sundays, with trading beginning in Asian markets on Sunday evening and ending in New York on Friday afternoon. The market is open to anyone with access to the internet and a trading account, which can be opened with a Forex broker, such as ourselves, Equiti. The Forex market is characterized by high liquidity, low transaction costs, leverage, which allows traders to control large positions with a relatively small amount of capital. So here I'm going to talk a little bit about the advantages of investing in the Forex market. So the value of a currency here is determined by market forces, including supply and demand, economic and political factors, and speculation. Currency pairs are traded in the Forex market, with the most popular pairs being the Euro USD, USD JPY, and GBP USD, which I'm sure that you've heard the common names. So the first advantage that we have here is that profit is both in both trends upwards and downwards, where upwards you can buy if you see that the pair is going on the upward trend, and downwards where you can sell if it's going on the downside. And the possibility of trading at any time convenient for you, as I've mentioned before, that the market's open 24/5 and with huge liquidity, which I'll take you through in just a bit. Now, also, in some brokerages, you can trade without additional commissions, which is obviously a great advantage, especially if you're an individual trader. You can also start trading with a very small amount. For Equiti, there's no like specific amount that you have to open a trading account with. So you can start with $500, $1,000, you name it. And now this takes us to trading with leverage. And let's say you want to trade, this means that you can, even if you have a small amount of capital, you can still trade with big leverage and turn your account from, let's say your initial capital was $1,000, you can trade with, let's say, $30,000 or $50,000. So there's no limits here. Obviously, there's a downside to this, that you do have to do your risk reward calculations and make sure that your trades don't have a huge amount of volume that will actually make your losses huge. So this has to be done very carefully. Now, the next thing is the possibility to open a free demo account, which you can obviously try trading on before you actually make trades. This can be like a trial and error process where you can trade all the currency pairs that you'd like, or the let's say shares, the buying and selling of shares or commodities, and as well as major indices, which a lot of clients prefer to do. Another key advantage is that no one can control the prices. The prices move by supply and demand. So there's no specific person or, let's say, government that would actually control the prices. The prices are made equivalently by just supply and demand. So the market participants, the key market participants, are big banks, trading companies, hedge funds, governments, central banks, and individual speculators. Obviously, you should know that this is a speculating kind of field. So you speculate that the price is going to go up and down based on specific analysis, such as fundamental or technical analysis. So here we have the most important, or let's say the most major important traded currency pairs that start with the Canadian dollar, the GBP, the euro, the CHF, Swiss franc, the USD, the AUD, Australian dollar, the New Zealand dollar, and the Japanese yen. Forex traders use a variety of tools and techniques to analyze the market and make trading decisions, including technical and fundamental analysis, as I've previously stated, and sentiment analysis. There's also different trading strategies such as scalping, day trading, swing trading, and position trading that can help you manage your account and basically set up an account that is suitable for you to make the profit that you need. Overall, the Forex market is a dynamic and exciting market that offers opportunities for traders and investors around the world. But it's important to remember that it involves risks and requires a solid understanding of markets and its conditions. So here we have the types of currencies that are most traded, or let's call them the major pairs. You'll be hearing this key terminology a lot, major currency pairs. Like I've stated before, that it starts with the US dollar, the euro, the GBP, the British pound, the Japanese yen, the Swiss franc, the Canadian dollar, and the Australian dollar, and the New Zealand dollar. You will also hear a frequent terminology being used across the FX field, and it's called crosses. And this is a pair which the US dollar is not a party of, like the Euro JPY, the Euro GBP, and the Euro CHF. So the major pairs are pairs consisting of the US dollar against one of the major currencies, as previously mentioned, the GBP, JPY, CHF, and Euro CAD, New Zealand dollar, and the Australian dollar AUD. So what does a currency pair mean? Here we have base currency and quote currency. Let me use my mouse. So you basically, to buy €1, you have to pay $108 at this point of time. Obviously, market changes through various conditions. You'll see intense volatility that today we may see the euro is at 108, but tomorrow we may see it at 109 or 107. And prices do fluctuate frequently, and that's why you really need to understand the basics of fundamental and technical analysis, which is also done in the pipeline of this educational webinar series and journey. So each pair has an exchange rate that expresses what is paid in the second currency, which is the quote currency. So here we have the USD, known as the quote currency, and the euro as the base currency. So in the FX field, or also in the commodities and stocks, you can take advantage of falling prices through short positions. So not only you can buy if you expect prices to go up. You can also sell if you expect prices to go down and make profit of the sell position that you take, known as short. It's also one of the key terminologies that we often or frequently use in this market. So a financial position is taken by opening two opposing positions, buy or sell. So let's say you are buying the euro. Consequently, you are selling the dollar. So if you open a position, you are buying the euro on the euro USD, you are buying euro, you are selling dollar at 108. Closing a position, you are selling euro and buying dollars at 109. The position is called buy because we have purchased the base currency, which is euro. And here you can sell euros and buy dollars at 108, close a position, buy euro and sell dollar at 109. And this is called short sell because we bought the base currency. So basically here we call shorting another key term for selling. How to benefit from the currency movements. Unlike most money markets, the currency market makes it possible for trader to make profits from the rise and the fall of the market. So you'll see a lot of sellers in the market, and this also goes back to demand and supply. So if we expect the price to go up, it's called long buying. Also, long is another key terminology used or often used, frequently used as buy. It's a buying process for the pair to take advantage of the price rise in which the base currency is bought and the corresponding is sold. Example, if you expect the euro USD price to rise, you will buy the pair, you will buy the euro. So it's longing, you are longing the euro. And if we expect the price to go down, short selling, selling the pair to take advantage of the falling price in which the base currency is sold. Example, if you expect the price of the euro USD to fall, you will sell the pair, i.e. you will sell the euro. So it's very simple to execute and to close positions. If you are already familiar with MT4, this is an example of how MT4 looks like on your phone. And this is how it looks like when you want to make a market order or when you want to buy or sell a position. Our second webinar series will be an introduction into MT4. So in case this might be a little bit too complicated for you, this will be definitely explained in the next webinar series where we take MT4 in depth into explanation. So here, this is a market execution order. You can sell and you can buy. You will always be given these two options as to what to do with the price according to how you speculate the price to go. So here we can see that the euro back then, it was at 117. Like I said, prices fluctuate very frequently. Right now, we may see it at 108, but at that time, it was at 117. And the volume is basically the lot size that you want to take on the order. And it's important to always measure the risk and reward ratio of your initial capital. So even though that you have, let's say, $500 in your account, but you want to trade with really high leverage, you can take that through this channel over here. However, you really need to go back to your initial profit, to your initial capital in case that you don't actually succeed in this position. It will remain a negative balance in your account. Now we also have, in simple terms, if you expect the price to fall, you click on sell by market. And if you expect the price to rise, you click on buy by market. The stop loss and take profit are also necessary things while you're taking a market order. So stop loss can stop your loss from being, let's say, exceeded. And I will show you that in the next webinar series, and as well as the take profit, where let's say you expect the euro to go from 108 to 109, and you want to take your profit at exactly 109, or let's say 109.50, then you will just write your number here, and that's how you do it. Now, the buy price, sell price, and spread are also common terms that you will be seeing here. And in addition to how we have here a sell and buy by markets, you will also notice on the chart that you will have bid and ask price. So the spread is the difference between the bid and the ask. So bid price is if the bid is lower than the ask price, the price is at which you sell the currency pair. So bid prices are where you sell and ask prices are where you buy the currency pair. The ask price is usually higher than the bid price because it's usually when you're trying to buy something, it's obviously higher than when you're trying to sell it. Spread is the difference between the bid and the ask. This is the cost of trading. This is how brokerages make some of their profit through the spread. It is the profit margin of the party that carries out the buy or sell orders from bank, brokerage company, exchange office, or others. And it's also the size of the spread that can be determined by this formula. So spread is really important when you're, let's say, choosing a broker or trying to, let's say, minimize your expenses. So spread is a really important factor when you're trying to take a market position. Now, one thing that I do want to mention is that when you try to buy or sell a currency pair or a commodity or gold, oil, whatever it is, this is called as taking a position in global financial markets. So we place this as also another key terminology, good for you to know. It's basically known as taking a position. Now, notice in the figure that the increase in the buy price, 12341, in this right corner over here, from the sell price, which is at 123.38. So if you do like a calculation here from 12341 to 12338, you basically subtract 38 from 41, and you will have 3. 0003, that is, the spread is equal to 3 pips. You will notice also this is another important factor to digest when you are calculating the number, or let's say how much the price went down, how much the price went up. Pips is a really important figure that you would like to look for, especially when calculating, especially let's say you're still a new trader and you don't want to take such a high risk of making like a calculation through 123 and you expect the price to go to 124. No, you just want to take a position when it's like 123.38 and that it will go to 123.48. So just that number, 10 pips, let's say. So the spread here is often small and varies from pair to pair. So this is where you calculate your pips. If you want to take a lower risk kind of position, this is where pips come in. So how does trading work exactly? You need a contract price, you calculate your pip, and a profit and loss account. Lots. Lots is a very common term that we use for new traders. Lots, every time you take a position, you need to choose a lot size to take on that position, meaning the quantities of trading contracts are standard units for trading in the currency market and have three types. Standard contract, standard lot, which is 100,000 units of the base currency, and a mini contract, which is a mini lot, and it's 10,000 units of the base currency, and a micro lot is 1,000 units of the base currency. So in case this seems more complex to you, it's quite simple. One lot is, which is standard lot, which is the most common lot size clients prefer to take, as 100,000 units of the base currency. And it's just important that you know that, for example, €1 USD is you're buying 100,000 units of the Euro USD. That's how it works. Trading in the currency market is through the standard units. For example, you can buy 3 standard contracts or 2 mini contracts, and you can also buy contracts and a half and so on. So you don't have to just buy a standard contract. There's also many that prefer buying a micro lot. It depends on your account size. It depends on what's your investment goal. It depends on how much risk you're willing to take. All these things come into consideration when you're choosing the lot size. Let's say we have various risk takers and they want to trade with 100 lots. So that's an extreme amount, or even more than that. And we have individual traders that want to keep their volume up to 0.3. So this can be really just up to you. So 100,000 units in a standard lot means $10 approximately. And 10,000 units of the base currency means $1 approximately. And 1,000 units means 0.1 as well. Just a second, I will try to make the screen less blurry for you guys. Okay. Okay, so here we're talking about pips. A pip is a measure of the movement of currency pairs representing the 4th decimal place in the exchange rate of a pair. Example, if the exchange rate of the USD CHF, and I said this is one of the major pairs, moves from 10700 to 10701, it means that the pair has risen by 1 pip. So notice here that the pip is basically the 4th decimal place after the dot over here, after the first decimal. So it's the 4th number. If the price moves from 10700 to 10710, it means that the pair has risen by 10 pips, which is the 3rd decimal point. And if the price moves from 1700 to 1600, it means that the pair has fallen by 100 pips, and so on. I will reply to you guys and say, okay, moving on to the number of pips that you guys need to calculate, or at least to kind of understand, have a key understanding of what are we talking about when we're talking about pips. 8 means 800 pips because it's a 2nd decimal. 7 is 70 pips because, like I said here, it's the 3rd decimal point. And 5 is the 5th pip, which is the 4th decimal place, which I said here, it is 1. So if the price moves from 1,700 to 1,600, it means that the pair has fallen by 100 pips. And you will see that a lot of traders calculate the number of pips and they try to understand, or at least if you're reading the news, you'll understand that, let's say the Euro USD or the USD CHF lost 100 pips. So this is what we mean by pips. It's just a calculation of the number after the main number over here. Or if we're talking about 100 pips, we are talking about the 2nd number in the decimal place. I hope the screen is more clear now to you guys. I've changed the latency settings. Anyways, moving on. The pips for the Japanese yen pair is different. The only one that carries a difference when we're talking about the major pairs. One pip represents the second decimal place in the exchange rate of the pair. And the fifth decimal digit in the exchange rate of the pair is the third digit in yen pairs. So unlike the normal or the let's take an example here as the AUD USD. So when we're talking about the pair moving from 30 to 60, so it means that it's increasing, the price is rising by 30 pips. For the USD JPY, it is not 30, it means 40. Why? Because the price here also changed. So it didn't just change from 60, it's this first decimal place after the decimal. Unlike on a normal pair, it's the fourth decimal place that we're talking about. 1 pip, 10 pips, 100 pips. So for the USD JPY pair is the only pair that has a difference representing the second decimal place in the exchange rate of the pair instead of the fourth decimal place in a normal pair. So how to calculate the profit and losses of trading in dollars? Before I go there, I want to talk to you guys about something else. Just give me a second. So just before I get into the calculation of how to calculate profits and losses and pips, I hope that you guys understand now the key terminologies that we often use, like pips and positions, pairs, and such. I also want to say that the Forex market is characterized by high liquidity and low transaction costs and leverage, allowing you to take large position, which is relatively in a small amount of capital. However, because leverage is involved, Forex trading carries high risk and should be approached with caution. Hence why we do try to calculate the positions that we take. So we don't just take them on speculating the price. We need to take everything at one go. We need to know what's going on in the market. We need to know the technical aspect of the move in prices. We need to know what is moving the prices. So if pairs are moving, there must be justifications as to why they're going up or down, or at least as to an intense sharp drops or sharp highs. And this is why we try to understand more about the analysis scope of it, but I will not talk about that now. Definitely, we're going to discuss this soon. But the reason why I gave you the Euro USD and the USD CHF, because the most traded pairs in the FX field or in the FX market are the Euro USD, USD JPY, and the GBP USD. Hence why it's very important to you to know the tools. And traders use a variety of tools and techniques to analyze the market and make decisions, including all these analysis. And there's different kinds of traders, which we'll also get into on a later date, that do scalpers, that trade in minutes, day traders that don't leave floating positions through the days, but that is something that you can do, and swing traders and position trading. So as Equiti, we don't just offer CFDs on FX pairs, but we also do have commodities like oil, gold, silver, coffee. We also have stocks like Tesla, Apple, Microsoft. These are growth stocks. But if you're also interested in value stocks, we do also offer value stocks like Goldman Sachs, and so on, like financials or industrials. Financial markets are influenced by a variety of factors, including economic indicators, government policies, geopolitical events, and investor sentiment. So therefore, to calculate your profit and losses, you do need to keep an account. A lot of things that will take you through it all, but it's important that you do calculate the profit and loss aspect of it, just so you don't lose the initial capital that you've placed, especially if you're an individual trader and your initial capital is limited. So how to calculate profit and loss by pips. Assuming you open a mini lot on the Euro USD at an exchange rate of 108, if the exchange rate rises to 109, you will make a profit size 109 subtract 108 is 100 pips. So you've made a profit of 100 pips. However, if the exchange rate drops to 107.50, you'll achieve a loss of, subtract again 108 from 107.50, which is equal 50 pips. Now, we have a way by a value, or let's say colliding the pip loss or profit that you made, and then we take them and calculate the value of them into dollars, and that's how you know how much you lost. And that also depends on the volume or the lot size that you took. So multiply the size of the profit and loss, multiply by the value of the pip, which is equal to $1 for the mini contract and pairs where the US dollar is the quote currency. So the value of the profit in the first case is 100 USD. So here you have made $100. And the loss value in the second case is $50. So here, because we're just talking about this pip, okay? We're talking about this pip. And obviously here I wrote 109, but the price is actually, let's say 109.00. And again, it's the fourth decimal number. And that's why I'm saying it's 100 pip and not just one pip. However, just like you made 100 pips here, it means that you've made $100. And here, just like you lost 50 pips, it means that you lost $50. So again, like I said, the key advantage here to new traders is that you can open a demo account and start trading on it, start experiencing what a chart looks like, how to place an order, how to buy or sell, how to take advantage of prices, how to read these patterns, which are, again, this is just the first webinar series of education that we're doing, but later on we're going to take you through a tour of more in-depth technical analysis. What are the different kinds of chart patterns? What are the different kinds of indicators? These will all come steps by steps. But the important thing is that you did understand that we do have these major pairs that are that you can trade, and these crosses that are mostly traded in the Forex market, being the largest, one of the largest financial markets in the world. So if you do have any questions, please do ask me. I hope I did go through everything about introducing to you guys the global financial markets. And again, I just want to remind you that we don't only have currency pairs, but we also have commodities. We have stocks, we have major indices. A lot of traders like to trade the S&P 500 or the NASDAQ or the Dow Jones that have the 30 most prominent US companies and just one benchmark or one index. And this is why it's basically global, and it's one of the biggest financial markets in the world. And the nice part about it is that you can diverse your portfolio or account into different kinds of things, but obviously it's nice if you just focus on one thing at a time, just till you learn let's say how much is oil, what moves oil, what are the things that are inversely linked to oil, or let's say if the dollar is linked to the gold, how do they move together? So there's a lot of things to learn, but I do hope that I was insightful to you today with everything to do with how to open a live account and how to open a demo account. This will be on the Equiti website as soon as you get on it. And it will also take you into MT4 or MT5, your choice. And yeah, that's it. Thank you guys for tuning in, and I'll see you in the next educational session.